This crypto trading strategy uses all three elements of analysis. Firstly, technical analysis. We'll be using the Fibonacci retracement tool to show us exactly where to get into trades. Secondly, long-term Bitcoin cycle analysis. We can see clearly bull markets and bear markets. This shows us where we want to go risk on and where we want to go risk off. Thirdly, we're going to be using Bitcoin on-chain analysis, and this gives us key data as to how Bitcoin actually moves and reacts in cycles. And you can use this trading Bitcoin and altcoins as well. Firstly, we have to get some crypto to go ahead and trade. I trade on Bybit, so I press buy crypto, fiat deposit, and then put an amount that you want to deposit onto the platform. If you don't have a Bybit account yet, check the link down in the description. You can get up to $30,000 as a deposit bonus if you're new, and that ratchets up depending on how much you deposit. So even smaller amounts get a deposit bonus. You can use that to go ahead and trade as well. I'll leave some beginner's guides as well down below. If you don't know how to use these platforms, get money in and out, all of those videos down in the description. Now we'll look at using the Fibonacci tool on our charts and how to put this on properly. So the Fibonacci retracement tool, as the name suggests, looks for potential retracements in the price of an asset. So the crux of this strategy essentially is we wait for Bitcoin bull markets. They are pretty easy to spot. The sentiment changes. We're going to look at that in this video of how we can spot these bull markets. In a bull market, the price action is also very simple. You get moves to the upside, you get the price in discovery moving up. Then you reach a top and you actually get these drawdowns. So we're going to trade those drawdowns and those retracements. A bull market is higher high, higher low, higher high, higher low. We want to trade the higher lows. We want to trade the drawdowns. That's going to give us a good opportunity in terms of the percentages and the odds to actually get into trades and hopefully make some trading profits. So fib retracement, this is going to give us areas where the price may retrace to during uptrends. So I'm going to very easily draw this on the chart. Fib retracement in TradingView. So I'm going to use TradingView because it's much better trading chart software. You do get this free for Bybit and other trading platforms as well. But in any case, go to tradingview.com. It's completely free. Sign up for an account, use this for free. Go to fib retracement on the left. You go from a low to a high. You can very clearly see these lows and highs, right? You can see the up move here, up move. These are the essentially higher highs in a bull market. These are the moves that can retrace. So we go to fib retracement from a low to a high. I'm going to draw it on. Now I'm going to go to my settings because I've changed this fib tool. These are the settings that I use and these are the fib areas that I use. So just pause the video or have a look at that. These are the ones that I use. These are the ones that most traders will use, right? And so these are the areas that you want to trade. Okay, so that's one. We can actually put it on multiple of these, right? So we're going to go from a low to a high area, and that is a potential retracement. So what is the fib showing us? The fib is showing us essentially these moves, which are percentage moves from a low to a high, and then where we actually draw down from this high move into a retracement, these are many times and oftentimes the area that these retracements will get to, right? And so if we know these areas, these are the areas that we can place trades. How do we actually use the Fibonacci to go ahead and enter trades? This is actually down to the individual trader and how you want to play this. So we have a low and we have a high and then the drawdown right here. There's three levels that I use. So the 382, the 0.5 and the 618. So how do you want to play it? Do you want to put a third of your order in at each of these levels? You can do that. So a third, a third, a third. Or do you want to put most of the order in the middle? So let's say you put 80% of your order in at the middle and you go in 20% here and maybe 20% here, trying to get your average price down. That's also a good strategy. It's important to know and use on-chain analysis to understand what's the volatility of Bitcoin and how much does it usually move in these uptrends with highs and lows. That's important because as long as we know what the general move is, then we can make trades around that. If you're getting in too much too high, you do have the risk of getting drawn down on, and that's going to make you feel uncomfortable in the trade. If you wait too long, you may not get an opportunity to actually get in at this level. I'll show you an example of this. During this week, we had a perfect drawdown, right? To this level, the mid, and then the lower level. 3 levels all hit, and then we moved higher. On this trade, if you had waited till the lower 618, you wouldn't have got anything done. It actually almost didn't hit the 0.5 either. And so it's important as an individual to figure out how much do you want to put in at each of these levels. But you have to use these levels to get into trades at some point, right? So if you want to wait to the 0.5, or if you want to start getting in earlier at the 382, you can do that as an individual. Maybe 80% in the middle, 20% at the sides is pretty good, to try and bring your, cost down. Or, of course, if it isn't going to move down there, you at least want to get some of the trade done. So it's up to the individual what you want to do there. One thing Fibonacci can absolutely not help us with at all is fundamentally knowing whether the asset is in a bull market or a bear market. For example, if I draw Fibonacci on the chart right here, so we had this drawdown, we had a low, and then we have a high, right? And so Fibonacci would say, okay, we're going to get a drawdown into the golden pocket here. Let's go long and see a bounce up. But fundamentally, the asset had topped out and was going into a bear market. So what we do is use the long-term cycle analysis. We want to be very sure that this asset is relatively low given its longer-term trend and is recovering or going into a bull market. If we're trading there, we have a much better odd of actually making trades on these drawdowns profitable, right? Because if you're trading drawdowns in a bear market, you're going to get wrecked, right? Because it draws down further. So we need to know we're in a bull market. Luckily, this is fairly simple with BTC, and then you can do this for altcoins as well, because if Bitcoin's in a bull market, altcoins may be as well. Go to TradingView down at the bottom, click logarithmic on the chart. This is a Bitcoin chart here. It's going to give you a chart like this, very long-term chart. Now, what I'm doing is drawing a midline, an upper line, and a bottom line here. And you can use this. You can go to drawing tools, go to curve and draw that on. And then these price levels here, what I've done is go to this and go to price range. You can draw these on and color them. Very simply, I've seen areas where Bitcoin goes into bear markets and drawdowns towards the bottom of the range, recoveries, you have the halving here, and then the move up to the top of the range. When Bitcoin is at the top of the range, it's really got nowhere else to go other than, bouncing at the top or maybe entering the next bear market. Recovery here, move up into the top. And so this is important because where do we want to take trades on drawdowns? We want to take trades in pullbacks and drawdowns in bull markets and recoveries. So we have a recovery, we have a bull market, and it's really important to know that where the price is in relation to its trend. So for right now, as I'm making this video, Bitcoin is about on its trend. If you're trading down here, Bitcoin is below its trend, but recovering. If you're trading long when Bitcoin is up here, that is not playing the odds, because where can Bitcoin go if it's at the top of its range? Can it go higher? Very, very unlikely. It never has done that if you look at the logarithmic chart. So it's important to fundamentally know this and what area of the market you're in. If you're trading against the tide, you are going to lose. You cannot swim against the tide. You have to go with the tide when we're trading like this. We can trade these drawdowns in bull markets only. If we are trading drawdowns in bear markets, things are not going to work out. So that's important, firstly, before even deciding if you want to use Fibonacci and other technical analysis tools to actually get your entry levels. Before we go ahead and enter our trade, let's look at on-chain analytics to give us an idea of how Bitcoin moves. And then we can tie that with the first thing we looked at, which is the Fibonacci to enter our trades at these levels. These are bull markets for Bitcoin. It's on-chain analytics to show us how the price moves. We can see that in bull markets, you get drawdowns. These are bull market drawdowns. This is actually a free metric on Glassnode, so go and search for it. It's Glassnode and then Bitcoin bull market drawdowns. So each of these bull markets, we can see that Bitcoin does always draw down, anywhere from 20 to 40%. That's as simple as that. So in bull markets, when we realize Bitcoin is in a recovery or a bull market, we know for sure there will be many opportunities to trade a drawdown of 20 to 40%. Sometimes it goes a little bit lower. You have to watch out for those, but 20 to 40% is the normal range that Bitcoin will draw down in a bull market. Now that we know that, we can take that and use Fibonacci with the 20 to 40% range to actually make our trades on those drawdowns. Going full circle back to Fibonacci then, we know 20 to 40% drawdowns are something we can trade and are regular within BTC. So this is the current chart. We can see we have a low and we have a high. Now, many opportunities to trade in the Fibonacci retracement levels. This has been from the range high around anywhere from a 20 to 33% drawdown, right within the typical range of drawdowns in a Bitcoin bull market. If we go back, we can see this as well from the range high to the range low, 20%. From the range high to the range low, 19%. High to low is 22%. And this wick right here down to the very low right here is 20%. Those drawdowns occur, we can trade those. We can also use Fibonacci to give us confluence as to where we actually enter those trades. So again, like I said, 382, 0.5, 618. Make the trades, make the amount of volume that you trade here. It's up to you. 80%, 2020, third. It's up to you where you actually want to get in with how much volume. I'll show you how I would go ahead and enter trades based on this strategy then. So I'm just going to connect my wallet to Apex. Apex is Bybit's decentralized exchange. So if you don't want to use Bybit for any reason, you have crypto in your wallet, you can just connect your wallet here. So I'm just signing this transaction to actually sign into the dApp. I'm just connecting it with my wallet. I don't have an account or anything. Just connect with your wallet and trade. So I'm actually going to deposit on here. I've got some assets on BNB chain. I'm just going to show you how to do this. So I've got some USDT here that I want to deposit into the platform. So I'll just go and sign that transaction and deposit it into the platform. So you have some stable coins you want to trade with. Now Apex is more of a derivatives exchange. If you don't trade derivatives, just go and trade in the spot market on, Binance or Bybit or OKX or one of the others, right? But once you've got some assets you want to go ahead and trade, I'll actually show you how to open trades. When placing trades, then we can't just think about the actual trade that we're in. We have to think about the whole holistic trade. So I've gone back to Bybit here as you'll be trading in the spot market, right? So what do we do in the spot market? Buy and hold the asset, accumulate as much as possible. So during bear markets, we absolutely need to be buying as much as possible. That's where all the returns are made, in bear markets, buying these lower prices. In bull markets, and you can see these drawdowns, we have to be at least active here. Now, if you just want to dollar cost average through the whole thing, you can do that. Bitcoin annualizes at around 40 to 50% a year right now. So if you have a long-term time horizon, let's say 10 years or eight years or 2 cycles, 40 to 50% a year, maybe coming down a little bit as it matures, it's pretty good returns, right? You're going to be outperforming everything. Just dollar cost averaging, buying every week. But if you want to be a little bit more active, even in the spot market, if you're just buying and holding Bitcoin, these are the areas you have to get in. You can use Fibonacci, you can use the drawdowns, it's all here, right? So that's how you would trade spot, in my opinion. Now, for the more active trades in the leverage bag, if you want to trade that, then we can do that. And that we have to be a lot more specific and tactical there. If we're taking shorter term trades, and especially if we're taking leverage, the whole entire strategy changes. What we need to do now, if taking leverage, is make sure that this is only 10% of our portfolio. The rest has to just invest in the asset class, get those returns, have those savings there. That's the strength that we have to go ahead and actually wait for other opportunities. If you're desperate to make money putting all of your portfolio into each and every trade, you're eventually going to get wrecked. We need strength in the market. We need to know that we're good anyway. And when opportunities present themselves, we actually have that strength to go ahead and trade actively as well. So the first thing I'm going to do is look at the Fibonacci levels. This was the latest move. We've got the drawdowns here. I'm going to put 80% of my trade in at the 0.5 level and then the last 20% in at this level if it gets there. Now it has on this occasion. So we'll go back and actually enter the trades based on this. We also have to use the drawdowns and Fibonacci to give us a stop loss. If you're trading with leverage especially, we need a stop loss. We need to keep that trade to a small percentage of the portfolio. So this is the drawdown that we actually had, which from this range high, the 0.5 level is a 23% drawdown. This is a 30% drawdown. And we know that 50% drawdowns are possible, but quite rare. We don't want to get caught out on one. So what's a 50% drawdown? We're going all the way down to around about 37K on that trade. So I would make sure that any leverage that I take isn't going to liquidate me above that level, right? So I probably want to be taking 2x leverage here, something like that, and making sure that my liquidation price for that trade falls nowhere in this red box. So if that's the red box here, that's the risk reward for our trade. Getting in here, letting it run, seeing what happens, hopefully the next leg higher at some point. We don't want to get liquidated anywhere in this box. So our stop loss is probably around this box, around 36, 37K. Now back in my trading screen, all I have to do is make sure that my trade doesn't get liquidated or essentially loses before my own stop loss, right? So this was the 0.5 level on the Fibonacci, 54,000. So that's 54,000 entry. I'm going to trade with $100, 108 here. What's 2x leverage? 2x leverage means you put half down into the trade cash to actually fund that position. So 54 times 2 is 108. So 54 is what I'm putting down into the trade to pay for any potential losses. 108 is the size of the trade. If I go up to 3 or 4x leverage, you'll see that the size of the trade does not move. I just put less down in the trade. So now it's working, essentially this 108 is 4x of my collateral that I'm putting down. The higher leverage you go, the less you put down in the trade. However, what that also means is that your liquidation price is going to move up. Because if you have less money to pay for losses, that means a smaller move to the downside is going to liquidate your position over time. So all of this is down to the individual. How much leverage do you want to use? How tight your stop loss is going to be, right? That's up to the individual. I would recommend less leverage, right? It's a volatile asset. And so we really just want to keep our positions as much as possible in a bull market. 2x leverage, we know that we're buying with $54 here. It's going to open a $108 position. So we can just buy long here, confirm, and actually goes in. So you get that buyer here. So we've got a long way to go before we get liquidated. It's way underneath our own stop loss, right? And so we can actually keep that position for a long time. The main thing is here, we just want to keep the position in a bull market. We don't want to get wrecked. If you take more leverage, a smaller move to the downside is going to wreck you. But that's more aggressive, right? You can be more aggressive and try to actually say, you know what, my stop loss is going to be tighter, higher up. I can use more leverage, and that potentially can give me higher gains to the upside, but it gives me more risk of actually just losing that trade and losing that money. So when trading, 10% of your portfolio, let's say you get 5, 6, 7 opportunities like this in a bull market, you definitely want to be active for all of those. So that 10% needs to be split up into different trades as well, right? You go all in on one, you go aggressive, you get wrecked, well, that 10% is gone. So 90% investing, 10% like this, split it up into different trades. Take calculated risks on this over time. Some will lose, you'll win a couple as well. But if you're taking 2x leverage, a couple can lose, maybe a couple are winners, you can actually ride them out. Now, when to take profits? I think the only logical way to approach profit taking is to actually go back into the high time frame charts. We don't want to take profits at arbitrary levels. It doesn't mean anything in a bull market, right? Because you are essentially hitting new all-time highs anyway. So what are you going to do? Well, we can go back into the high time frame charts and very clearly see risk on and risk off areas. When you are at the top of a range and the top of the bull market, that's a pretty overbought level for BTC in relation to its longer term trend. It's very unlikely that you're going to get another bull market after the price is at the top of its range. And so they are areas where I wouldn't be taking any new long positions. Therefore, why am I in any long positions? And so those are the areas. Don't look here. It's not going to help you. If you're in a bullish phase and you're trading these bullish drawdowns, which they are, then what we want to do is hold them until the actual market, until the actual price and market and cycle is mature, where we say, you know what, there's no risk reward in taking long positions anymore. That's when you need to get out, in my opinion. It's not arbitrary figures of 10, 20, 30%. It's time again. So using high time frame and low time frame together and all the other technicals and on-chain analysis, try to put a trade strategy together, try to play the odds. Check the links in the description if you do want to get some deposit bonuses and fee discounts on the exchanges I use. I'm James, this is BlindDG. Cheers for watching, and I'll see you in the next one.